All right, well, hello everyone, and welcome to another session of the Microstructure Exchange. Today, we're very excited to have Patrick Chang from Oxford here to present about anonymity, signaling, and collusion in limit order books. Patrick has said that he's very happy to take questions live throughout. So if you have a question, please just go ahead and raise your Zoom hand or interrupt to ask that. And Patrick's co-authors will also be present, and so might also be able to respond to questions if you put them in the chat. And then one other announcement before we get started. As you've probably seen, we have a call for papers. We're looking for submissions for our spring session. So please submit to that call for papers, and the submission deadline is going to be on December 15th, so in a couple weeks. All right, so without further ado, I'll turn the floor over to Patrick. Patrick, please take it away.
Thank you. Thank you for having me here. So this paper is with Álvaro and Rob. So Rob works at the Dutch regulator, but this work is independent from them. The only connection is the fact that Rob works there. So it's just a bit of disclaimer before we get any further. So we're going to be looking at Euronext ETF market, and just a bit of background stats, some concentration numbers. There's about 300 or so ETFs in the market, I think. And on average, one market maker takes around 50% of the market share, and the top three take around 60%. Whether this is concentrated or not, I'm not too sure about the particular number, because we know from theory that two players are technically enough to keep the prices competitive. But just for comparison, numbers for equity is around 16 to 20% respectively. So one of the main things about this market is Rob was scanning through the data, and he found this interesting thing where these market makers, but a bit of a misnomer, these guys are really HFTs, seem to be revealing themselves to the market. And they do so in one of two ways. One is they post extremely large volumes of the limit order, in the sense that it kind of doesn't make any economic sense from our perspective. And the second one is they add trailing digits to the limit order. So if you take the quantity of the limit order, if you just look at the last two digits, there's a very particular pattern in the way they do it. The trailing digits isn't our main focus, but I think it's a very intuitive way to understand the sort of revealing yourselves in the market. And the consequence of this sort of revealing themselves is the way in which these market maker HFTs take or do not take liquidity depends on the volume posted by people in the limit order book. Specifically, what we see they do is they target small limit orders, which are most likely sent by retail traders. And they avoid trading with large limit orders sent by their other market makers. And so basically the limit order book is no longer anonymous as we kind of expect it to be. And market makers seem to know where each other are sitting within the limit order book. Why this is interesting is because anonymity is not often talked about, but it kind of plays an important role. Imagine you're providing liquidity, and if you receive a trade from, say, me versus George Soros, kind of very different. You probably prefer to take an order from me than George Soros. And so, but the effect of anonymity is quite interesting. It could swing either way. It could be good for the market, it could be bad for the market, but there's a lot of different ways to for anonymity to occur, or transparency effectively. And the way these guys are revealing themselves is one is called pre-trade anonymity. Basically, you know who each other are before trades occur. So we've given this talk a lot to a couple of firms, and you can imagine the reaction being quite intense. But one thing that we found surprising was they find it surprising that we find this surprising. Effectively, this seems to be kind of common knowledge among people in the industry. And to kind of reflect that, after the first draft of this paper, Risk did an article about our paper. and they got a couple comments from people in the industry. And these comments kind of reflect the fact that it is common knowledge. So Matthias Paas, he's sort of head of a HFT lobby group in Amsterdam. And he says adding trailing digits is a well-established and legitimate practice in European ETF markets. And they do so to track their own limit orders. And another person from a large US bank said it's almost a professional courtesy to identify themselves by their signature quantities. So this guy, he was a trader. So we found him on Twitter by accident. Um, he was just giving comments about our paper on Twitter, and we ran into his post. And he worked at Citadel, and before that, I think he was head of ETF trading at Flow. But he basically confirms what we're saying. They used to do this to recognize their own orders, and then they started recognizing the handles of their rival firms, and then start to factor this information into their own strategies. And basically, the practice continues because it doesn't breach any rules and provides valuable information to the market makers. Strictly speaking, he's correct that unless there's sort of express communication to implement this agreement, it kind of falls in the loophole of tacit collusion. But yeah, the question for us is why would you do that? Obviously, if you're the one getting the benefit, it's obvious why you like people to reveal themselves. But for one of these players, why would you participate, or where are the incentives coming from for you to participate and reveal yourselves to each other? Like, why would this allow you guys to make more money, for example? So we're going to study a model that rationalizes the behavior. And basically, we're trying to highlight the incentives for these HFTs to reveal themselves to each other, and basically study what conditions this will occur and how they mutually benefit and enforce this behavior. And obviously, the bottom line is simple. They break anonymity to make more money, and they do so by being able to spot retail flow and to avoid trading with each other. So here's an example. This is Vanguard S&P 500. It's the largest ETF on Euronext Amsterdam. And these are sort of the trailing digits. If we take any limit order with a volume greater than 100, we take the last two digits and plot a sort of histogram of the frequency. If we remove all sort of normal multiples of 10, 25, or usual human numbers, what we see is there's some odd spikes here. So this largest spike here is 87. What is particularly interesting is this has been going on for at least 5 years, from 2016 to 2021. We have managed to decode a couple meanings behind this, but sort of this got into, when we were given the data, so with the data, we weren't allowed to reveal or isolate a specific individual, so we couldn't really dig into this further because of those restrictions. But we found basically a different equivalent, which was limit order size by dealing capacity. So here on Euronext Amsterdam, to send an order or anything, you have to register you have to tag your order with what capacity are you trading under. And there's a couple of capacities: retail, market maker, house, and client. So retail are people who trade off Robinhood, for example, and market makers are what they actually end up being are HFTs who want to utilize sort of fee rebates and register and provide liquidity under this. Others include house and client, I think. So house are people who trade on their own account, and clients are, for example, a bank executing an order on behalf of a large institutional client or some rich person, for example. So, sorry. What we mean, so if you just look at the sort of distribution of limit orders sent by each type of participant, we see that the median size of a limit order sent by a retail person is about 500 euros, whereas the median order of a market maker is 120,000 euros. In shares, it's 4,000 and 6,000. The median transaction on ETF is about 700 euros, while on shares is about 4,000 euros. So on ordinary shares, this is kind of what we expect. The size of the trades roughly correspond to the available liquidity offered to the market. Whereas in ETF, sort of the benefits from liquidity provision, 700 euros, versus sort of the risk you expose yourself to just do not align with each other. Yes, we're comparing ETF to shares, which are not apples and apples, maybe like apples and oranges. But the fact is, certain aspects like adverse selection, latency arbitrage remain true, whatever kind of market you're looking at. And sort of a consequence of these is you do not want to provide excess liquidity because you don't receive any benefits, but you're subject to the risks of being adversely selected or latency arbitrage. So it's not clear why these market makers are providing more liquidity than what is demanded in the ETF in the ETF market. And a bit more background information in this ETF market. Retail accounts for about 70% of all transactions and about 30% of trade of the total volume in Euronext Amsterdam. So it's quite a non-negligible amount of retail participants. So we actually looked, well, one of the things, we didn't know why this was the case. And I think it was during our chat with BlackRock that they told us why this is the case. In Amsterdam, they have very strict payment for order flow rules. So basically all of the retail order flow is diverted to the exchange. Whereas say in Germany and London, the retail order flow is a bit more spread among the exchange, systematic internalizers, and I think TradeGate for Germany. And so this is the reason why ETF is such a big component in the Dutch market. So what is the consequence of this signaling, right? And we're going to study this through a very narrow range of behavior. We're going to look at sort of what we call sniping. If you read Buddish, he refers to latency arbitrage as sniping. We're going to call latency arbitrage and sniping to this particular behavior. So what we mean by a snipe is if a spread improving limit order comes in, improves the existing spread, here's a bid popping in over here and improve the existing spread. And then immediately an IOC order initiates a trade of any size. So you can completely take out the order or just partially take out the order. Anything, any trade that hits that limit order, we consider a snipe. And this must occur within 1 millisecond. That's our definition of a snipe. What is quite cool is how fast this occurs. Don't know if you can see here, but if I zoom in a bit, from here to here is about 1 millisecond. And what we also checked that the average time these orders survive for is about 87 microseconds. So basically, from the moment the retail limit order arrives and that order gets processed, distributed to everyone, to the point where HFT see it, execute it, and then it gets published, that whole round trip thing takes about 87 microseconds. Yes, on average. So looking at this, focusing on this particular behavior, what we have here is sort of the fraction of how much you improve the spread by. So 0 to 0.1 is basically a very small undercut versus 0.9 to 0.1 is you're sending a new order that effectively crosses the spread, but just falls short. And over this range, we see that retail is quite uniform in which the way they post their orders, their limit orders. Whereas market makers do seem to be a bit more strategic, that they post that there's a lot of undercutting and fewer and fewer and fewer as sort of the range increases. But apart from what is entered, let's look at what was taken. If we look at the percentage of the orders that were taken, it's particularly, let's say this region, 90 to 100%, So these are effectively orders that nearly cross the spread and just fall short by, let's say, one tick. You're basically sending a market order, but just failing to hit it, right? So for these orders, if that order came from a retail trader, that order is picked up with around 63% probability. But if that same order came from a market maker, that order is touched with 0.08% probability. It's astronomical differences. And the only difference effectively is the size of the limit order over here. So apart from the sniping, the second effect of anonymity, breaking this anonymity, is it also changes the way they trade with each other. So these are all the transactions split by aggressive and who's the passive on the passive side. And we see that market maker on market maker activity is only 4,677 trades for the whole month out of 340,000. And to put this into perspective, that corresponds to less than one trade between market makers per ETF per day. These guys are quoting nonstop, revising their quotes nonstop, and there's less than one trade between them per ETF per day. And taking this, compare again ETF to shares, not the perfect comparison, but just to give you a rough idea of what perhaps it should be. This translates to 1.37%, but on equities it's around 24% of all transactions between market makers. Any questions so far?
There have been a couple of questions in the chat, but I think Rob has been doing a good job of responding to them.
Okay, cool.
If anyone has asked a question in the chat and wants to follow up on what Rob has said, please unmute yourself and ask live.
Yeah, I just love more details on what kind of advantages that the market makers actually get in the market and what kind of special privileges. So I would love as much granularity and detail as you can give me on that one.
Right. So this is just a dealing requirements for Euronext. It basically allows them to track what orders and they're quoting. Basically, these are the orders that are going to be checked for quoting requirements so that they can receive fee rebates and incentives for meeting certain requirements, right? So these orders get sort of discounts. If you meet the fee requirements, these orders get a discount on passive trades or aggressive trades and stuff like that. So it's not really, a firm can trade under multiple dealing capacities. It's just which orders do they want to receive benefits or, depending. For example, if you're a bank and you're trading on your own account, you'll have to trade under house. But if you're trading on behalf of, say, Man Group, you'll have to trade under clients. So these are just sort of institutional rules that govern. But the main thing about market maker is to receive fee rebates.
And how big are the rebates compared with the fees that non-market makers pay?
So I think over here, if the market maker fulfills the obligations, they receive a 50% discount on make fees. I think that's the only benefit for these market maker fees. Well, the fees for market makers. And obviously there's tier structures with based on trading volume. So you get different fees depending on how much volume you trade.
Yeah. So 50% of the make fees, any sense as to where the take fees are for these things?
I don't remember the exact number, sorry. But again, it's on tier basis, so it's quite a wide range. I think they're more expensive than the make. I haven't looked at the documents in a while, so unfortunately, I can't remember. I don't remember the number.
Okay.
Cool.
I have a follow-on question to that. So, is there any obligation on the market maker to provide liquidity? I mean, if they are obligated, maybe it's a strategic choice to. Like in terms of the time of the day, you have to be on the best bid and ask. Yeah.
Very good. And that's part of the explanations, one of the explanations we're going to explore in a bit. So let's hold off on that for just a little bit and I'll get right into that, if that's okay. It's coming up in a couple of slides. So let's look at a couple sort of feasible explanations that might potentially explain what is going on. So we know ETFs is a collection of assets, and in this particular case, there's probably a lot of public information, right? Like a jump in a particular underlying will need to be reflected in the ETF itself as well. So one could argue, for example, that perhaps all of this is public information. And if it's public information, if the price went up, for example, and I revise my bid to here, of course, as a market maker, I wouldn't take another market maker's order because, it's reflecting the correct price. So that could explain why they do not take these orders from market makers, but it's inconsistent with the lack of transactions between market makers. Because we know from Buddhist paper, the latency arbitrage, that if it is public information and the price went up a lot, that should result in a latency arbitrage race. And taking the numbers from our table from before, if we look at, if we assume, symmetry, that the fundamental value is the midpoint, if a bid goes beyond the midpoint, so any range beyond 50% to 100%, that would mean the fundamental value is now beyond the ask. And that, in theory, should trigger a latency arbitrage race. So there's around 800,000 of these cases where sort of the bid or the ask went beyond the midpoint, but there's only 4,000 transactions. Taking Buddhist calculations and some, back of the envelope calculations, what we should have seen is a minimum of 250,000 transactions due to latency arbitrage. Basically, market makers being too late to cancel their stale orders. So public jumps could potentially explain some, but it doesn't explain the lack of transactions. Another one is potentially flickering quotes. So Hasbrook and Saar studied flickering quotes, and they found that these are limit orders meant to, as a strategy to demand liquidity. And they're basically searching for latent liquidity, trying to execute against hidden orders, or they are trying to invite someone to pick them up, to attract a marketable order, what we call a snipe in our paper. And so in Euronext Amsterdam, there are no hidden orders. They're only iceberg orders where at least part of the limit order is visible, not the whole thing, but part of the whole thing. So flickering orders can't be used to search for latent hidden orders. So that if that's the case, flickering quotes must be used to attract a snipe. Now, if you're a market maker and you want your order to be hit, you wouldn't send a big fat order to scare, the other participants away. You'd probably send a tiny order, to blend with retail and get someone to pick you up. So the dominant strategy was to blend with retail orders, but we clearly see that's not the case. So going back to the quoting requirements, yes, there are quoting requirements on Euronext Amsterdam. And the benefit of that is to reduce fees. But the quoting requirements is to provide continuous quotes on 80% of the day and a cumulative size of 100K. What we've presented before is the size of per order. There's no reason to not split your order into tiny little, 1K, 1K, 1K increments and scatter them along the whole book. And within there's a big range with which you can do this. So depending on the particular ETF, you need to quote within 2 to 6% of the mid price, and so you can split your orders all along that whole range. So there is no reason to concentrate all your 100K order on a single quote at the touch all the time. You can do a convex price schedule. So your quoting requirements could provide a bit of explanation, but given the fact that the requirement is cumulative, it doesn't explain why you quote so large per order. And if you're still not convinced by that, there was a natural experiment on Euronext Amsterdam. I think it was in 2023 March. They reduced this cumulative requirement from 100K to 50K. And again, looking at Vanguard, the largest ETF in the market, if you look at the mean and median quote before the change and after the change, when they reduced the quoting requirement, these market makers started quoting even larger. So these requirements are in no way binding or constricting the behavior in a way that they need to quote so large. Does that answer the question that you had?
Only partly, because it could be like who's taking this out? Is it necessarily market maker who's sniping, or it could be other retail
Oh, yeah,
orders who
sorry.
say, well, let's trade inside the spread.
Sorry, these are all basically 94% of all these orders are taken up by a market maker. The other sort of 6% are by basically a market maker trading under their house account.
Okay.
So basically all the market makers. And by the way, the median sort of time for this is 87 micros. So all HFTs.
Okay.
Cool. Any questions before we go into the theory?
I just wanted to make sure that I understood the 100,000 euro requirement.
Yes.
Could they just quote that for 1 millisecond and meet their requirement, or is that 100,000 for 80% of the day?
80% of the day.
And but if they did like 100 million for a few percent of the day, would they still be in there?
It will count towards that percent, but that's about it. If that makes sense. So the 80%, you're quite flexible in how you can play with 80%, right? If you're trying to attract a snipe, you could effectively flicker that for, let's say, 1 millisecond, and that would basically consume nothing of 20% in which you don't have to quote that day. So there's a lot of flexibility in playing around these requirements. And you could also quote very deep in the book to meet the requirements in some sense, and then pop a bunch of these small orders at the within the spread at the touch to sort of blend as you would in a what you'd expect. Cool.
But sniping is the most cost-effective way of doing it then, right? I mean, so you're 80% of the time you can earn wide spreads. And if somebody is trying to damage that, you just take it out.
Of course.
And the spread becomes wide. Yeah.
Of course. But if a market maker should also then, if they want to trade, should also send a small order so that someone else would snipe them. What we're seeing is that they don't do that.
Yeah. Okay.
And sort of that's the kind of thing we want to explain with the theory.
So non-competitive behavior. Okay, I see.
Why are they not sort of mixing with sort of the uninformed flow as you would expect in most of these sort of classical finance models?
Yeah. Thanks.
Cool. Perfect. So we're going to work off the Bordishley and Shim paper. Obviously, we're going to keep the main elements of latency arbitrage and adverse selection. And we're going to add informed HFTs. And their short-lived private information comes from market fragmentation. And Rob has a separate data set called MIFID, where he could see basically all the trades for across Europe. And what he did see is that, quite interestingly, these HFTs aren't all connected to all the venues. So let's say there's like 9 venues. HFT 1 is in venue A, B, and D. HFT 2 is in B, C, F. Kind of this behavior. They're not all connected to all the same venues. So the way we're sort of thinking about this private information is it's very short-lived private information that comes from the fact that not all exchanges are connected to the same venue. So there's a bit of minor delay, when you're plugged into the venue versus when receiving data from a third-party data vendor. And sort of another key generalization is the introduction of retail investors who send their limit orders that improve the quoted spread. So there's a paper that Josh sent me that was a little bit similar to this. This was Lee et al., who provides liquidity and when. So they have algorithmic traders that also send orders that come within the spread. But the missing element that makes this a bit more interesting, I think, is we have informed HFTs as well. So there's kind of this sort of Bayesian game within the spread too, in our case. And basically, the ambiguity is that there's informed HFTs plus retail limit orders. And this ambiguity arises because limit orders are anonymous. So if the HFTs are correct, are being strategic and blend, it's impossible to tell who is who just based on the order you see alone. So our model tries to understand why the HFT would be willing to reveal herself to others, and how do they mutually benefit from revealing themselves, and how do you enforce this as in you would in a collusive arrangement. So let me just get to the punchline before we go any further. So if you want to take away, this is probably all you want to take away. So in the model, if there's too much private information, basically, if an informed HFT, if an HFT is informed, has a way of information, he's going to try send an order that mimics a retail order. And by doing so, there's a chance that someone will take that order and they effectively adversely select themselves in some sense. You're sending a toxic limit order so that you can make some money. And so if the toxicity is too high over here, it will no one would snipe because it's too costly to, get hit by someone who's informed. And if that toxicity is too high, these orders that improve the spread don't get removed. And they continue to sit in the book for a while, so the HFTs can only provide liquidity on one side of the book. So by breaking anonymity, what happens is two things. One, they get to pick off these retail orders when they come because they know who is who now. If we're all willing to reveal our hand, we know who retail is, we can pick them off when we want to. And when we pick them off, that side of the book opens up. And that allows us, basically, we remove the competition from the retail limit orders. And that allows the HFTs to also provide liquidity on the other side of the book that would have otherwise been unavailable to them. So basically, you get profitable flow from retail investors and you remove competition. And the effect is liquidity takers have to always trade at the spread set by the HFTs, and they never get to trade with retail limit orders. No one else gets to trade with them except us. And both of this allows the HFTs to earn excess profits, which they will enforce through some mechanism. So that's sort of the key punchline of our theory. And to get into the nitty-gritty.
Could I interrupt and ask a question just on the previous slide?
Yes.
Thinking about the key punchline of the theory and trying to connect that to the two ways in which you extended this Boudish-Lee shim model. So I can definitely see here on this slide the role that allowing for retail limit orders is going to play in your story. But the other generalization that you highlighted was informed HFTs. And I didn't see where on this slide that was playing a role. I was wondering if maybe you could speak to why it's important to adjust in that direction as well.
So in the baseline case, so when you're not cooperating, right? HFTs, they're just there to make money. So if they have the information, the best way to make their money is actually with that one piece of information, they can make money in two ways. One, they can send an order, pretend to be retail, and get someone to basically adversely select themselves. So that's one trade they can do. And then they can go adversely select, the other side of the book. So they can get a double whammy. So, but just looking at within the spread, if the probability that it was an informed HFT, if that is too high, there's no incentive for people to pick up these orders that come within the spread. You're too scared because it's too toxic. And so when that is the case, one, you basically lose out to picking a retail when it's possible. And then two is the competition of the retail when it does come there. It blocks the HFTs from providing and doing latency arbitrage on each other on the one side of the book. So that plus that along with the retail gets the ambiguity, and that creates a whole different sort of a sub game within our game. Cool. So we're going to mostly follow Boudish. We're going to have a security X with fundamental value Y. It goes up and down with equal probability, and the distribution of the size of the jumps is given by J. We have impatient investors. These are the noise liquidity takers. They arrive with some probability, equally likely to buy and sell, and on arrival, they send a market order to transact immediately. Then we have the patient retail investors. They arrive with some probability, equally likely to buy or sell. They submit inside the spread a limit order that is mispriced in some sense. If they send a bid beyond the fundamental value or a sell below the fundamental value. So that's our assumption. And then we have HFTs. They make and take liquidity. Their only objective is to buy at prices lower and sell at prices higher than Y. And the information, there's two types of information. There's public information, and that gets spread to everyone. And there's private information that is only seen by HFTI, and we assume that the HFTs are equally likely to be informed. And as the usual, there's no latency for HFTs, and if multiple messages reach the exchange at the same time, it's processed at random, so it's random tie breaking. And so as a consequence, when retail races against an HFT, the HFT always wins. So retail cannot really participate in these latency arb races. So we're going to have 4 periods in this trading game. And basically at period 1, HFTs observe the book and send orders to the exchange. In period 2, nature is going to pick one or two things. One, a patient investor, or 2, give out private information to a particular HFT. And so in period 3, if a limit order arrived, the HFTs have the opportunity to take it and modify any limit orders they want as afterwards. In period 4, if nature gave someone information, it's going to do nothing in period 4. And if it pulled a retail investor, it's going to pick one of 3. It's going to bring in a impatient investor, release public information, or do nothing. And any outstanding limit orders from patient investors cancel at the end of the trading game. So in effect, our game tree looks like this. Period 2, nature's going to pick one of 2. And then, but depending on what nature picks in period 2, it's going to pick one of 3 in period 4. So let's focus on the case of the competitive equilibrium. I'm just going to walk you through what's going to happen in equilibrium. So in period 1, the HFT, one or multiple HFT will maintain 2-sided quotes around Y. And in period 4, if there's public information, they'll raise to pick out stale quotes, and HFTs will also, cancel to avoid being latency arbitrage. And if there's private information, the HFT will adversely select one of the HFTs providing liquidity. In period 2 and 3, this is the interesting part for us. In period 2, if a limit order arrives, it is either from a retail investor or an informed HFT who pretends to be a retail investor. So upon seeing a limit order in period 2, in period 3, the uninformed HFTs either snipe the limit order in period 3, but when they do so, they face the issue of they don't know who the order is from. Is it from a retail, a benign limit order, or is it from an informed HFT who knows more than you, right? Or they can wait to pick up the retail as a free option in period 4. So instead of racing to pick them up in period 3, you can hold off, and then wait till you know what's going on in period 4 to pick them up. But when doing so, you lose out on liquidity provision on one side of the book and sniping the liquidity provider on one side of the book, depending on your role as the HFT. So again, just to put this in a bit more picturesque style, let's consider the case where you are sniping in period 3. In period 1, you're going to quote symmetrically around Y. In period 2, let's say a retail arrives and sends a bid over here. Because you're sniping, you've taken them out. And then over here, in period 4, depending on what happens, if it's a liquidity taker, public information, stuff will happen according to what was discussed before, the usual bullish part here. So there's a little interesting bid here. Over here, we see that the bid tightens. Because if it was an informed HFT sending a bid over here reveals 2 things to everyone. It reveals the direction of the private information, and 2, it reveals the size of it, at least, partially. An informed HFT would only submit a toxic bid, if it is profitable to do so. And that means the jump is at least bigger than delta. So that's one piece of information. And by submitting a bid, he knows that the price is going up. That's your second piece of information. So over here, what happens is there's one side of the book that will face adverse selection and the other side of the book that won't face adverse selection. So as a consequence, one side of the book will tighten compared to period one because of the new information that comes through the bid. What is particularly interesting is revealing this two information has no effect on the profitability of the informed HFT. It's kind of weird that knowing that the jump is at least bigger than delta doesn't change the way I price over here. It's kind of weird, but the math shows it's true, which is, I found that surprising. And the second thing is giving the direction doesn't change anything because there's no way for an informed HFT to, for example, bluff and make money, basically misguide the other people to make money. There's no way for them to do that. So that rules out all these other off-equilibrium behaviors. So the weakly dominant strategy for the informed HFT is whenever it's profitable, is to always submit the toxic order, whether it's going to be sniped or not. It's a really, really interesting part that pops out of the model. So the other case in period 4 was, let's suppose they don't snipe. The informed HFT, when if it comes here, if a retail comes here, no one takes it out, and you see that the HFTs don't get to provide on this side because they don't want to provide excess liquidity. So this will be the quoted spread following in period 4. And the informed HFT, again, because it's a weakly dominant strategy, will continue to send this. And the only case of him making money is to adversely select the market maker over here. Sorry, by the way, over here, if it was an informed HFT, there's two trades that can occur for him here. One is when he sends the bid here, someone's going to snipe him. That's profit number one. And then after that, in period 4, before the information becomes public, he adversely selects the market maker on the side. So he can get a double whammy over here. Any questions before I continue?
There have been a couple questions in the chat, but I think Rob has been replying to them pretty diligently.
Cool. Yeah, I see I'm running out of time, so I'll pick it up a little bit. Some notation here. This is the usual Buddhist stuff. So this one is just to reflect the fact that if the informed HFT submits a limit order, changes the information set a little bit, that now the person providing liquidity will know that the jump is at least bigger than delta. So it's just a bit of notation to reflect that. We're going to denote that if they choose to snipe as D equal to 1, and if not, D equals to 0. So we're going to do backward induction over here. So this is for what are you going to quote as an uninformed HFT in period 3 upon seeing a limit order arrive in period 2. So a lot of different stuff here, but what's quite simple here is if no one is sniping, the retail order continues to live there, and you can pick that up upon public information coming out. You know it's safe, you can pick this retail order up here. If you do choose to snipe, you'll get a portion of the retail orders that arrive divided by however many people are racing to pick up these limit orders, minus sort of the cost of accidentally sniping an informed HFT. And the double sum is just to account for the fact that an informed HFT won't race to snipe their own orders. So it's just a bit of math there. And this is the benefit from liquidity provision, less the cost of latency arbitrage in period 4. Here is is an interesting term, which is if someone has sniped, that opens the other side of the book for someone to also provide liquidity here. And the final term is just the latency arbitrage, adverse selection cost. So what is quite interesting is if you write, these are the probabilities, and if you expand this out, these things cancel. And so the cost is equal to the usual this term over here. So this is what I mean by that extra information about the jump size being bigger than delta doesn't affect how you would price your order on the side that faces adverse selection. It was quite surprising to me when I saw this. So these are the payoffs associated with liquidity provision. What if you were a uninformed sniper, a latency arbitrager? You have the same terms. If no one sniped, you get to pick up retail. It's free game for everyone. And these are the costs and benefits you get for if you chose to snipe in period 3. And this is the portion that the one side of the book that's always available to all the HFTs. And this is the side of the book that's only available if someone decides to pick up these orders that appear in period 2. And so the equilibrium spread it needs to be that the HFTs are indifferent between being a market maker or a latency arbitrager. And these are the 2 equations that solve this equilibrium condition. And of course, the side that faces adverse selection has a higher half spread than the side that doesn't, except when there's no private information. That's kind of trivial. Going back, once we have that, we can go to the next step, which is who is going to snipe and who isn't. So we're going to only focus on the symmetric case. And basically we have 2 conditions. One, if the money you make from picking off retail outweighs sort of effectively the cost of being fooled by an HFT, an informed HFT, everyone's going to be happy to snipe. So this is kind of trivial. And when the other case is if you shuffle this term to the left-hand side, we see that if private information becomes too high, this condition is going to hold. So if private information is high, the HFTs will not snipe in period 3. It's quite intuitive. So a quick summary of what's going on. Here's just a quick summary. On time, I'm going to skip this to get to the collusion case. Any questions before I continue?
Patrick, maybe it makes sense for you just to wrap up, and then we can take questions all at the end. Okay, sorry. Got you. So for the case of the collusive equilibrium, we're only going to focus on the case where D0 holds, so that HFTs do not snipe in the competitive equilibrium. This is going to provide the most insightful case for us to understand the incentives. And we're going to consider a simple strategy. It's going to be related to the green imported trigger strategy. And the idea is to cooperate. When they cooperate, they signal all their limit orders with some quantity greater than 1. So they are immediately distinguished to be an HFT instead of a retail order, a retail trader. And they're going to take turns to provide symmetric spreads around the fundamental value. And they're going to each take a proportion of 1 over n times being the market maker. The idea is they're not going to latency arbitrage each other or adversely select each other. And these guys have to be compliant and respect to take turns to provide liquidity. And another rule is do not pretend to be a patient investor, and all HFTs raise to snipe any retail that arrives in period 2. It's free game for anyone. And so that's when they're cooperating. What if someone cheats? If someone cheats, we're going to revert to competitive play for T periods of the trading game. And we're going to revert if a market maker is latency arbitraged or adversely selected, or someone is not compliant, taking more time than they should have on providing liquidity. And if someone snipes a non-signaled limit order from period 2 and loses money. So this can happen in one of 2 cases. One, it was genuinely retail, but the price simply went the wrong way. So, this guy got unlucky. The second case is one of us is cheating. If you're cheating, you're not going to, send a big order. You're going to pretend to be retail again. And when someone trades against you, they're going to lose money. So if one of these things happen, you're going to revert to competition again and punish each other. And so for collusion to be profitable, the additional payoff from cooperation must be greater than when you're from competition. And rewriting this a little bit, we come into the main thing. We can ignore this. This is just the wider spread. It has no implications. You don't need this at all. It's just to make the paper flow better. Here's where the money's at. If
we basically, if we're cooperating, what happens is we get extra money from picking up these retail investors early on. Picking them up in period 3, you get some money, but you have to take out the cost of not having picked them up in period 4 when they were a free option. So this is positive as a term. And the second term that's always positive here is now that they are removed, you actually receive additional flow from impatient investors, because now the other side of the book is open and you get to provide liquidity there. So there's these 2 effects that happen simultaneously. You get extra money for picking up retail, and you get extra money from opening up the book and removing competition from these retail people. So these are the 2 effects that happen. That's where the money's coming in. And so to complete this collusive arrangement, we need to be able to deter cheating. And basically, there's 2 types of cheating. One is going to be the latency arbitrage or adverse selection. And sort of the maximum gain you can get from that is this term K. And these deviations are perfectly observed. If someone gets adversely selected or latency arbitrage, that's going to be perfectly observed in the next round. The other case is cheating by pretend to be a retail, like sending a order within the spread when you're informed. And so the payoff from that you get is this, and this is imperfectly observed, because you will never actually know if it was genuinely someone cheating or genuine retail, but the price moved the wrong way and you guys got unlucky. But nonetheless, this can still be sustained so long as this signal is sufficiently informative. So the probability of triggering a punishment phase by accident, basically it was retail and we got unlucky, is this. And if someone is cheating deliberately, here's the probability of triggering the punishment phase. And so long as this difference is large enough, the collusive arrangement will go through. And just to summarize, these are the basically incentive compatibility conditions required to sustain this arrangement. And yeah, I think that wraps up my time. Given the time, I think I'll end it here.
All right. Thank you very much, Patrick. And now it looks like we have some time for further questions. If anyone would like to ask a question, or if anyone would like to follow up on some of the conversation that's been in the chat, please do so.
Yes,
Bjorn?
Very nice paper, Patrick. Would it make sense, you think, to look at realized spreads to see to what extent the market makers make money after price impact? I'm thinking that these spreads are huge in terms of number of ticks. According to the table, some of them have 100 ticks.
Yes, and I think Vanguard, the most traded one, has 30 ticks.
Yeah, for some reason, the market makers are not undercutting each other. So if they operate at break even, there should be 0 realized spread, give or take. So it would be interesting to see the realized spread for that reason.
If they are undercutting each other, there should be a 0 realized spread.
Well, not exactly 0, but they should make no profits, right?
Exactly. What is quite interesting here, again, I think this also relates to our discussion, what I mentioned before about the way order flow arrives in Euronext Amsterdam. What we checked is that the spread on Euronext Amsterdam is comparable to these other venues. Deutsche Börse, LSE, they're quite comparable. They're not greater, they're not smaller, wider or tighter. Sorry, but we know for a fact that the Dutch market seems to receive a lot more retail flow, and that just from Glastonbury should dictate a slightly lower spread. But I guess another aspect is if you're quoting wide and if you're quoting extremely large, And to break even, you'll have to quote a wider spread. So I guess just by quoting large, you artificially widen the spread. But there's obviously a profitable undercuts just from reducing the quantity offered and tightening the spread, right? Maybe that answers a bit of the question, but
yeah, thanks. Did you say anything about how many market makers there are in this ETFs?
Yeah, sorry. So here's the concentration figure, but across the whole ETF market, there are about 5 big players. Okay. And for some reason, it seems to be quite divided among which ETF. There's only about 3 per ETF, even though there are 5 across the whole market. It's quite interesting.
I see. Interesting. Thanks.
There seems to be segmentation there as well.
So is there anything stopping small participants? Like, why can't you become a market maker and start coding inside the spread to break this collusion in some sense?
Nothing. I think it's just the speed thing. For me, I don't have 100K to to play with them, and I don't have the infrastructure. But I don't think there's anything stopping someone like Citadel or I don't know, some other big firm coming in to stop this. For sure not. I think so long as you're an HFT, there is no reason to. But of course, there's more money to be made if you join the game this way.
Right. So that's why I'm wondering why there must be lots of financial firms who can make markets in the ETFs, right? There's not too much idiosyncratic information there.
Exactly.
So I don't know how it even gets into a position where the wide spread can be sustained.
So but we do see the fact that even though there are 5 big players here, they only divide themselves among around 3 per ETF.
Oh, okay.
So already that is a bit counterintuitive, I think.
Yeah, because this is just a press of a button. It's not like a real estate collusion where big firms charge 6% commissions here, for example. And it's hard to break that because nobody can suddenly become a real estate broker. But this one, anybody can open a brokerage account and then start coding, submitting limit orders inside the spread, right?
Subject to having speed advantage to also pick up these orders when possible.
Okay. Maybe that's right. Okay. Sounds good. Thank you.
Yeah.
Thanks.
Yeah, some U.S. exchanges have retail liquidity programs that identify which orders are retail. I'm guessing that Amsterdam doesn't do that. Is that correct?
They do. That's a beautiful question. They do. Amsterdam has this best of book program that is exactly the same as the NYSE retail liquidity provider program. And what is really funny is they don't use that thing. RLP, so retail liquidity providers, was an option in Euronext ETF for a very long time, and it hasn't been used, which is really funny, because effectively what this signaling is doing, it's basically mimicking this RLP in some way. Don't trade with each other's orders, but only trade with retail effectively. And they have this mechanism built in the Euronext Amsterdam. Best of book.
So if I'm deciding whether to snipe or not, I can see that it's retail and go, oh, I got it.
No, so I think same way as NYSE does it. Those can only be retail liquidity provider orders can only be aggressed upon. You cannot aggress retail orders.
Got it.
But those orders can only be traded on by retail, cannot be traded on by your competitor who can latency arb you or adversely select you. So that program is available on Euronext, was I think available on Euronext Amsterdam for a good period of time. And apparently it got taken off and put back again. It's really confusing, but it was there for sure.
Yeah, but Patrick, I don't know if my mic is on, but one has to remind oneself that if you're a retail guy going to a retail book, the spread you end up seeing has to be on average tighter than otherwise. So you're being forced to reveal yourself because of the way everything is set up, but you do not get the spread you should be getting when you reveal yourself as uninformed flow.
Yeah. So basically, like Álvaro was saying, a condition for these RLP orders is that they have to improve upon the existing BBO. So in NYSE, you have to improve the existing BBO for your retail liquidity provider order to go through. In Euronext Amsterdam, your retail liquidity providing order will only get traded so long as it's better than the BBO.
So I think that addresses a question Jim asked about, if I'm retail, what do I care? You know, I just want to get filled, I improve the spread, and I get an immediate fill rather than crossing the full spread. It sounds like a great deal. But I think the counterfactual has to be that you should be able to get the same sort of fill rate with a much tighter spread, because you have revealed yourself, given the way the whole thing is set up. I'm hoping that answers your question, Jim, that you wrote in the chat.
Yes, although let me throw out a heretical statement here. Yeah, we normally pretend that a narrow spread is better, ceteris paribus, but the spread is really the price of liquidity, and to assume that the optimal spread is zero is like assuming that any price should be zero and that a lower price of anything is basically always better. If the price of bread is zero, nobody provides it. So the real question is, how much of an option value is there to having an infrastructure of liquidity providers ready to fight over my orders? So I'll just sort of throw out there as a heresy and wait for you all to tell me.
I agree. But I agree. But in the US, people pay for these particular orders.
Yeah.
It's valuable enough for people to pay for it. And I guess, I don't know if that addresses that.
Yeah. No, I think it's really a social choice question that goes beyond most of our models here to say how can we value the fact that the liquidity providers are there all day long versus somebody like me who shows up every once in a while and does a trade.
Well, to me, if you look at the Euronext, and maybe Rob knows this better than me, but when you have the best of book actually working Euronext, you see that on average, the retail book has tighter spreads. So liquidity is cheaper simply because your flow is soft. But not zero, but it's cheaper. It's just a relative thing. So long as it's tighter, you would expect them to be doing what a Glossen-Milgrom approach to the world would be telling you, that informed flow is more expensive, so uninformed should be getting a better deal. But if there's anonymity, then you get a mix. When this is broken, then the uninformed should be getting a better deal because, as Pat said, otherwise you can also pay for flow so long as it's soft, and then that's a shadow price that is equivalent to a tighter spread. I'm not disagreeing with you, Jim, but all I'm saying is that you should expect, everything else being equal, to be quoted tighter spreads if you reveal yourself to the market as uninformed.
Yeah, these are fun things to debate.
All right, does anybody have any other questions? Last call.
I've always wanted to meet Nick Leeson, and he's kind of a hero of mine, and I see he's one of the participants. So I just sent Nick a private message and would love it if you got back to me.
Well, I read the name Nick Leeson, and I didn't know that it was the Nick Leeson.
Well, there may be more than one, but there's a very, very famous one that I've always wanted to meet.
Yes.
And maybe invite to be a guest speaker in my class. So, although I don't have a budget to pay his speaking fees.
That's great.
All right. Well, if there are
in the chat.
Other questions, then maybe we can wrap up here.
Great paper.
Right. Thanks a lot for the presentation, Patrick.
Thank you for having me.
See you all. And we hope to see you all back in 2 weeks for the last installment of the fall, when Patrick Spat will, or when Chester Spat will be presenting. All right, see you then.